Hello and welcome to my video lectures. I am Zakaria Arafat Nabi and today we will be talking about working capital basics. By the end of the session, you will know more about what is working capital, basic formula of working capital, balancing the working capital necessity, fluctuating current assets, permanent current assets, funding policies, conservative policy, aggressive policy, and matching policy. So let's moving on. So what is working capital? Working capital is basically net current assets. It is calculated as total current assets minus total current liabilities. So normally current assets include cash in hand, cash at bank, inventory and receivables. Current liabilities include payables and overdraft. So to keep your business running, you always need a good amount or an adequate amount of working capital. Therefore, your total current assets should be more than the current liability portion. Alright, so let's have a look. So this is the basic balance sheet. Alright, so here you have your assets, you have your owner's equity, you have the liabilities. So total assets will equal to total owner's equity and liabilities. Let's break it down. So here assets include current assets, fixed assets and intangible assets. Owner's equity include paid up capital, retained earnings. Liabilities include current liabilities, non-current liabilities. So you will be working with current assets and current liabilities. For working capital issues, we will only be working with current assets and current liabilities. So let's have a detailed look. Current assets include stock, debtors and cash. Current liabilities include trade creditors, current tax liabilities and bank overdraft. So always you should have this portion bigger, current assets bigger. There are many ratios and many other things which we can work down, but for this basic lecture we will only be focusing on the very basics. So what is working capital? The Google says the capital of a business that is used in its day-to-day operations. So this is the day-to-day operations, the money, the fund that is used to run your business from day to day, calculated as current assets minus the current liabilities. Alright, so here let's have a look. This is my current assets here and these are the current liabilities. Here my total current liabilities is 600 and the total current assets is 1200. Always remember one thing, current assets portion should be greater than current liabilities portion. Here it is twice. Alright, so that means you can at any time pay up all your liabilities and still you will have current assets left. Here you have cash 600 and your current liabilities are totaling 600. So you are in a good and strong position. Alright, but that might not always be the case. You might not always have 600 in cash. So this is where you need to manage this stuff, right? Again, there is sometimes when you have 600 in cash, you cannot pay up your payables, your liabilities, but again, you need more cash for something else. You need to fund something, so you need more cash. So what will we do? So we will be looking at that strategy later on. And again, it might be that you have this cash 600 which is an excess. So what should you do? Normally in business we do not keep excess cash just in the till or in the locker, right? So we need to invest it somewhere else. So let's have a look. Always remember current assets and current liabilities. We will only be working with these two sections. So let's look on what if you have surplus cash and what if you need more cash. So the rule of thumb is when you need cash, simply reduce current assets. And when you have enough cash, do the opposite, reduce current liabilities. So let's have a look. Alright, so when you need funds, when you need cash, what can you do? Simply reduce this section, current assets portion. See, you have stocks. So stock, when you buy something, when you stock something, you do it by paying someone money. You buy goods, right? You buy goods and keep it in your warehouse. All right, so if you sell those, you're going to make some money, and that money is cash, so your need is fulfilled. Again, you have these debtors, your receivables. You need fund. Decrease your receivables. Ask your receivables, your debtors, to pay up. Give them some discount and tell them to pay up earlier, right? So you're going to make some cash. So when you have a need for funds, you do these two things. Reduce current assets. You can also do the following. You can also increase current liabilities, right? So current liabilities include trade creditors, current tax liabilities, and bank overdraft. So you can be taking up more overdraft from the bank, but the bank may call back their money anytime. But still there is a possibility. When you need funds, you increase your liability. You take more overdraft facility, you use it, you use that fund. Again, when you need funds, these trade creditors, your payables, you increase your credit time, right? The credit period. Maybe they gave you a 30 days credit period. You say them, no, I'm going to pay you up in 45 days. Give me 15 days extra. But again, that has a drawback. Your creditors might be fed up with you because of your paying nature is not that good. But still, when you need funds, you can do those. You can also held up current liabilities, current tax liabilities, but be very careful. Do not persons, right? They might cause you many harm. All right, moving on. Sometimes in business you have surplus funds. You have a lot of money. Like in the example we saw, we had $600 in cash, right? Or 600,000 in cash, which was extra for us. So when you have extra funds, you can pay up your creditors. When you do not have any good opportunity to use that cash somewhere else, so you can pay up your creditors. You can pay up your tax liabilities. You can pay up your bank overdraft. So that fund is utilized somewhere. Again, you can do the following. When you have extra cash, you can increase your current assets, right? You can buy more stock, buy more stocks, buy more inventory, right? So that will give you, so your cash will be going out, will be draining out from your business. All right, so moving on. So there is an equilibrium, right? By now we understood that there is a problem if you have extra cash, and there is also a problem if you have less cash. So this is either a trial and error method. By trial and error, you are going to learn more about how to keep your working capital in an equilibrium. Or again, the nature of the business. If you know your nature of the business, when you will be needing cash, if you have the confidence in supply and delivery, the level of activity of a business, when you know that in which period of the year your business really requires a lot of working capital, a lot of cash, liquid money, so you can then make the working capital equilibrium work. You have to know a very good understanding of your company's credit policy, like how many days your debtors take up to pay you, and how many days you get a credit period from your payables, right? So moving on, balancing the working capital necessity. Current assets here are divided into fluctuating current assets and permanent current assets. Yes, you heard me right. Permanent current assets. Normally, that's not a very regular term used everywhere, but permanent current assets do exist. This thing is correct. It's not a typo. We will also be looking about conservative funding policy, aggressive funding policy, and matching funding policy. Those are funding policies. But let's have a look on these fluctuating and permanent current assets. So, fluctuating current assets, as its name suggests, is the changing part of your current assets. All right, that is the fluctuating thing that will be going up and down, right? All right, so this might happen maybe in some New Year's Eve when there is a buying spree all around the world, and you are also hoping for a very good business. And at that time, you are buying a lot of stock, and you're buying a lot of inventory and stocking them up in your warehouse, right? So that is the fluctuating part of your current assets. So permanent current assets, this is the fixed part of the current asset. Well, current asset also has a fixed part, yes. A permanent current asset is the minimum amount of current asset that the company needs to continue operations. So the minimum amount of current asset it needs to always keep in stock, always it needs to keep the basic business operation running. All right. This is true. Current assets is always replaced within 1 year. Permanent current assets will also be replaced within 1 year. This is not a fixed asset, not a long-term asset, but it is the current asset which behaves like a fixed asset. Let's see how. So here, look, a very beautiful showroom, very beautiful pair of shoes. All right. So these are all your current assets. This pair of shoes, this pair of bags. All right, these are all your current assets. But think for a second, when you sell some pair of shoes from here, will you keep your showroom empty like this? You will not like to keep it empty, because if you do, customers will not come into your shop. So whatever it is, whenever you sell a pair of shoes from here, you are going to replace it with some other pair of shoes. So these are current assets, but this will always behave in a permanent nature. They will always be replaced longer time than the normal current assets. So these are current assets, but these are behaving like non-current assets or long-term assets. So these are permanent current assets. And if you keep your showroom like this, customers will not come in, they will not come in. All right, so fluctuating current assets, when you have a lot of orders, or it's a New Year's Eve, or there is Olympics going around like now it is. All right, so there will be many people who will be influenced by the Olympics and like to try out some new shoes. Right, so at that time you will be stocking up. You will have a lot of fluctuating current assets. So this is a basic diagram. This short-term finance, long-term finance, these are all financing policies. We'll be looking at them later on. Total assets and the timeline. All right, so let's have a look. Non-current assets, this is the long-term assets. All right, fixed assets, these are the fixed assets. So these fixed assets will always be fixed in nature, and these permanent current assets behaves like fixed assets. Permanent current assets behaves like fixed assets. They tend to be fixed as if they were non-current assets, but really they are current assets. And their brother, fluctuating current assets, always keeps on fluctuating, keeps on oscillating. All right, keeps on variation. So this fluctuating current assets is always fluctuating. Look here, the level of business is very low. Here the level of business is even lower, but here the level of business is higher, and here it's even higher. Maybe this was a New Year's Eve, or maybe the Olympics was running at this time, right? So the level of business was very high, and after the Olympics was over, the business started to decline. So you are not stocking up much, you are not using your capital in current assets. All right, but this permanent current asset is always fixed in nature. Moving on. So let's move on to the funding policies. So funding policies, conservative funding policy. So in this type of funding policy, here it puts more emphasis on the long-term finance and uses it to fund non-current assets. So long-term finance is used to fund the non-current assets, that is your long-term assets. Permanent current assets, wow. So permanent current assets is your current assets, and also a portion of fluctuating current assets. So in this way, minimum short-term finance is used because you are using your long-term finance. Remember, this is the conservative policy. All right, so you are using minimum short-term finance. This is very stable but expensive. All right, because long-term finance is expensive. The longer you are holding up the finance, the more risk you are putting, right? Again, moving on. So let's look here. The long-term finance is used to finance the fixed assets. It's also used to finance current assets, and it's used to finance part of fluctuating current assets, right? Short-term finance is also used. All right, so this was conservative funding policy. Moving on, aggressive funding policy. So this policy is very aggressive, So this suggests to use short-term finance to fund all working capital and use long-term finance to account for all non-current assets. This is risky but profitable. So here, let's have a look. Aggressive funding policy. You are using a short-term finance to finance all the fluctuating current assets. You are also using short-term finance to finance the permanent current assets. So what is the problem here? Permanent current assets tend to behave like non-current asset, and this permanent current asset will be stocking or will be. So this long-term permanent current your finance. These current assets tend to behave like non-current assets, and they will block your short-term finance, which is risky because bank overdraft might anytime call back this fund, right? And in aggressive policy, long-term finance is used for non-current assets. Moving on. So in effect, here we are using the short-term finance for permanent current assets and exploiting the cheaper financing aspect. Short-term finance is cheaper than long-term finance, because in short-term finance, bank will get their money back in a very short term, so they tend to take less interest from you. But in long-term finance, bank really gives you the money for maybe 5 years or 8 years or 3 years, so there is a risk. Anything might happen in 5 or 8 years, right? So they take more interest. Also, using bank overdraft facility or payables to fund working capital is much more flexible. Whenever you need, you can vary the size. Whenever you need some funds, take some overdraft from the bank, right? Again, the side effects or the downside of this short-term finance is it should be replenished quickly. All right, so one source of short-term finance is holding back creditors, right? Is holding back your payables. So payables, they will be always knocking you, give our money, right? So at that time, even if it is useful, but again there are these drawbacks. At some time they might be putting a lot of amount of pressure on your business to pay up, right? And your relationship will be. So short-term finance is riskier, as the bank may call back their money anytime. It goes same as with the creditors. So matching funding policies, here the duration of the finance is matched with the duration of the investment. This is just the matching policy. Duration of the finance is matched with the duration of the investment. So thank you so much for watching my video, and we will be coming up with new videos very soon. And please subscribe to my channel, and you can also email me, or you can view my blog, or you can knock me in Facebook or in Skype. Please keep in touch. We will be coming out with new videos. To keep posted, please subscribe. Thank you very much. Bye bye. Have a good day.